Hey, folks, it's your boy, the Boss Economist, back with another scorching hot take on the absolute clown show that is global economic policy. Today, we're diving headfirst into the European Central Bank's latest tap dance routine, trying to balance on a tightrope while juggling flaming torches, all during a Category 5 economic hurricane. Spoiler alert, they're not sticking the landing. So, buckle up, grab your popcorn, and let's tear into the ECB's latest shenanigans, the US trade policy circus, and the Middle East powder keg that's got everyone sweating bullets. Oh, and of course, we'll roast the government mismanagement that's driving us straight into recession territory. Let's go. First up, let's talk about the European Central Bank, ECB, and their latest performance in Freiburg, Germany, courtesy of Governing Council member Joachim Nagel. Now, Nagel's out here telling us the ECB shouldn't commit to a certain interest rate path because, apparently, the world is just too darn unpredictable. Gee, thanks for the hot tip, Joachim. I guess the rest of us plebs thought central banking was just about sipping espressos and flipping a coin on interest rates, huh? But let's break this down for the regular folks and the finance nerds in the audience. Nagel's pointing to two massive storm clouds on the horizon, US trade policy and the escalating chaos in the Middle East. And here's where the ECB's flexible, data-dependent approach starts to sound less like cautious wisdom and more like a fancy way of saying, we have no freaking clue what to do next. Look, I get it, central banks have to adapt to changing circumstances. But when you're staring down the barrel of a potential recession, indecision is not a strategy, it's a surrender. Let's zoom in on the first big uncertainty Nagel's sweating over, US trade policy. Specifically, President Donald Trump's tariff push, which, let's be honest, is less of a push and more of a full-on freight train barreling toward the global economy. Now, Trump's been waving the tariff stick around like a kid with a new toy, threatening to slap levies on everything from European cars to Chinese tech. And here's the kicker, nobody, not even the ECB, can figure out whether this is going to be inflationary or disinflationary. That's right, folks, the world's top economic minds are basically shrugging their shoulders and saying, could go either way. Let's put some meat on those bones with the latest data. According to a 2025 report from the Peterson Institute for International Economics, Trump's proposed 10-20% tariffs on European goods could shave off 0.8% of Eurozone GDP by 2026 if fully implemented. That's not chump change, folks, that's billions of euros in lost economic activity. And here's the fun part, if Europe retaliates with its own tariffs, which, let's face it, they will, we're looking at a full-blown trade war. Remember the US-China trade war of 2018-2019? That little spat cost the global economy an estimated $1.7 trillion in trade disruptions, per the World Trade Organization. Now imagine that mess, but with Europe in the crosshairs. Yikes. But wait, there's more. If tariffs drive up the cost of imports, that's inflationary, prices go up, your grocery bill gets uglier, and suddenly, the ECB's dream of hitting its 2% inflation target starts looking like a fever dream. On the flip side, if businesses panic and cut production, or if consumers tighten their belts, we could see demand crater, leading to disinflation, or worse, outright deflation. Nagel's right to be nervous, but here's the real question, why is the ECB acting like a deer in headlights instead of, actually preparing for these scenarios? More on that later. Now, let's pivot to the second big uncertainty Nagel's clutching his pearls over, the Middle East. If you've been paying attention to the news, and I know you have, you smart cookies, you'll know that things are heating up faster than a microwave burrito. On June 23, 2025, Israel ramped up attacks on Iran, while Tehran vowed to retaliate against US strikes on its nuclear facilities. This isn't just geopolitical drama, folks, this is an economic Molotov cocktail waiting to explode. Here's why this matters, the Middle East is the beating heart of global oil production. According to the U.S. Energy Information Administration, the region accounts for nearly 48% of the world's crude oil exports as of 2025. If this conflict escalates, and let's be real, it's got all the ingredients for a full-on conflagration, oil prices could skyrocket. Just look at the data, during the 2022 Russia-Ukraine war, Brent crude oil prices spiked to $139 per barrel, the highest since 2008. Now imagine a similar shock, but with Iran, a major OPEC player, in the crosshairs. Goldman Sachs recently warned that a sustained disruption in Iranian oil exports could push oil prices to $200 per barrel by Q4 2025. That's not just bad news for your gas tank, it's a death knell for inflation-weary consumers and businesses across Europe. And here's where the ECB's indecision starts looking downright criminal. Higher oil prices mean higher production costs, higher transportation costs, and, you guessed it, higher inflation. The ECB's already struggling to keep inflation in check, with Eurozone CPI hovering at 3.2% in May 2025, well above their 2% target, per Eurostat. But instead of signaling a clear plan to tackle these risks, Nagel's out here preaching flexibility. Flexibility? Buddy, this isn't yoga class, this is a crisis. Now, let's get to the meat of the ECB's policy mess, interest rates. For those of you who've been living under a rock, the ECB has been on an easing campaign, cutting its key deposit rate from 4% to 2% over the past year. President Christine Lagarde's been out here saying the easing cycle is nearing an end, but the governing council is split like a bad reality TV show. Some members think the cycle's already over, while others are screaming for more cuts to prop up growth. Meanwhile, Nagel's over here playing the hawk, saying, we're in a good position to await further developments in inflation. Oh, really, Joachim? Tell that to the millions of Europeans watching their savings evaporate and their businesses teeter on the brink. Here's the data that should keep Lagarde and Nagel up at night. Eurozone GDP growth is projected to be a measly 0.9% in 2025, according to the International Monetary Fund's latest World Economic Outlook. That's barely enough to keep the lights on, let alone fuel a recovery. Unemployment is ticking up, too. Eurostat reports it hit 6.8% in Q1 2025, with youth unemployment in countries like Spain and Italy hovering near 20%. And don't even get me started on the PMI numbers. The Eurozone manufacturing PMI dropped to 45.1 in May 2025, signaling contraction for the 12th straight month, per S&P Global. So, what's the ECB doing about this slow-motion car crash? Well, they're taking a data-dependent approach, which is code for, we're just gonna wing it and hope for the best. Folks, this isn't leadership, this is cowardice. The ECB's job is to stabilize the economy, not to sit around twiddling their thumbs while the US slaps tariffs on German cars and oil prices go to the moon. And let's not forget the elephant in the room, quantitative tightening, QT. Nagel's out here saying the ECB's balance sheet reduction won't clash with lowering borrowing costs. Really? Because the last time I checked, QT sucks liquidity out of the system, which tends to tighten financial conditions, exactly the opposite of what you want during a growth crisis. But hey, what do I know? I'm just a guy with a YouTube channel and a calculator. Now, here's where we get to the juicy part, the part where we roast the government mismanagement that's turned this economic mess into a full-on dumpster fire. Let's be real, folks, the ECB's indecision isn't happening in a vacuum. It's a symptom of a broader disease, governments across Europe failing to do their jobs. From Berlin to Brussels, policymakers have been asleep at the wheel, letting structural problems fester while throwing good money after bad. Take Germany, for example, the Eurozone's so-called economic powerhouse. The country's been coasting on its export-driven model for decades, but now that Trump's tariffs are knocking on the door, Germany's industrial sector is in freefall. Industrial production dropped 4.1% year-on-year in April 2025, according to the status, and companies like Volkswagen and Siemens are slashing jobs faster than you can say, recession. What's the German government doing about it? Oh, just bickering over budget deficits and green energy subsidies. Brilliant. Then there's the EU as a whole, which has spent years patting itself on the back for its unity, while failing to address glaring economic vulnerabilities. Remember the Next Generation EU Recovery Fund? That €750 billion lifeline was supposed to turbocharge the post-COVID recovery, but as of 2025, only 60% of the funds have been disbursed, per the European Commission. Why? Because member states can't agree on how to spend the money, and bureaucratic red tape is choking the process. Meanwhile, small businesses, the backbone of the European economy, are going belly up at a record pace. The European Federation of Small Businesses reports that SME bankruptcies jumped 15% in 2024, and 2025 isn't looking any better. And let's not forget the fiscal hawks in Brussels, who are still obsessed with austerity even as the economy teeters on the brink. The EU's Stability and Growth Pact, with its arbitrary debt and deficit limits, is forcing countries like Italy and Spain to slash spending at the exact moment they need to be investing in growth. Italy's public debt is at 140% of GDP, per Eurostat, and yet the EU is demanding more budget cuts. Are you kidding me? This isn't fiscal responsibility, it's economic sabotage. Alright, folks, here's the bottom line, the ECB's indecision, the US tariff tantrum, and the Middle East chaos are all bad enough on their own, but when you add in government mismanagement, you've got a recipe for a serious economic recession. And let me be clear, this isn't just a European problem. If the Eurozone goes down, it's taking the global economy with it. The IMF estimates that a 1% drop in Eurozone GDP could shave 0.5% off global growth. That's a domino effect nobody wants to see. So, what's the fix? First, the ECB needs to stop hiding behind flexibility and start signaling a clear plan. If inflation risks from oil prices and tariffs are the biggest threats, then they need to be ready to tighten policy at a moment's notice, none of this wait-and-see nonsense. Second, governments need to step up. Germany needs to stop dithering and invest in its industrial base, not just pray that exports magically recover. The EU needs to fast-track those recovery funds and ditch the austerity obsession, now is not the time to be pinching pennies. And finally, let's get real about the bigger picture. The global economy is a mess because our leaders, whether in Washington, Brussels, or Berlin, prioritize politics over progress. Until that changes, we're all just passengers on this economic Titanic, watching the iceberg get closer. Alright, folks, that's all for today's episode of Boss Economics World. If you're as fed up with this economic clown show as I am, smash that like button, hit subscribe, and let me know in the comments what you think the ECB should do next. And hey, if you're a finance pro or just a regular Joe trying to make sense of this mess, check out our Patreon for exclusive deep dives and data breakdowns. Until next time, keep your wallets close and your skepticism closer. This is the Boss Economist, signing off.